Get away.
So thanks, Josh. Hey guys, thanks for everybody for coming. Um, I wanted to I'm kind of excited about this time because nobody ever wants to talk about mortgages because it's super boring. But now finally people kind of have questions about it, so it makes me kind of excited. But so it's a really weird time right now, guys. Not just with the coronavirus and us staying at home. And I know you have your own set of issues and problems. Josh and I were talking about yesterday with just the fear and the uncertainty with clients. Not, you know, is now the time to buy? Is now the time to sell? And there's also some crazy stuff going on in the mortgage industry. And so I wanted to kind of give you a very oversimplified version of what's going on to give you the knowledge to be able to talk to your clients and inject hope in them as well, because that's really what we need to be, is that light right now in this dark, crazy time. So, they're acting. Some of them are acting out of fear and anxiety, and we just need to be that steadiness for them. So, whenever this thing does pass through, that we were there as the professional and the expert. And so if I can just give you a little bit of information today that will give you some knowledge to get you through this time, especially if you have someone that is needing to borrow money to buy a house or needing a mortgage. This is kind of, if they come to you and they're asking, hey, I don't understand what my loan officer is telling me. Interest rates aren't as low as I thought they were supposed to be. I was approved last week and now they're saying I'm not approved anymore. I mean, these are the things that are happening right now. And so I want to kind of give you some background as to why that's happening. Okay. And it's a very simplified version, but this helped me understand it. Even I've been doing this for 15 years. So let me start by the transaction. If you've ever bought a home before, obviously you've guided someone through that process. You have the borrower goes to an originator like me, and we do the loan application, we get them pre-approved, and then they go and find a house with you guys, go under contract and close it. Okay. So we don't service our loans. A lot of companies don't. If you ever work with a mortgage broker or anything like that, basically anybody that's not a big boy like Chase or Wells Fargo or things like that, they do not service the loan. What they do is they sell it either at closing or after closing to a servicer. Now, the servicer, I'm just going to use Wells Fargo, okay, because everybody knows who they are. So as an originator, I have, 10 different investors, and let's say I close and we sell it to a Wells Fargo. They service the loan. All they're doing is they're acting as a liaison between he who has the money, which is the government, and the borrower. So if a borrower has any mortgage questions like, hey, I'm not able to make my payment this month, can we work something out? Or they have any escrow issues, they're basically the customer service center for that loan. Okay. So let's say someone gets a loan for $200,000 and it's sold to a servicer. That servicer will then, they don't own the asset, they just own the servicing aspect of it. So you got to kind of rethink that Wells Fargo doesn't own, billions of dollars worth of mortgages. They sell these mortgages to the government, Fannie Mae and Freddie Mac and Ginnie Mae. Okay, those are the big ones. And the government is the one that holds these assets. They're called mortgage-backed securities. But the servicer charges a percentage to be the customer service for those mortgages. Does that make sense so far? So that's how they make their money. Okay. So with that being said, the value of the servicing was about 1% before all of this started. Okay. That's basically what they would make to service the loan. They make a little bit of interest in 1% of the interest rate. Okay. So what has happened now is, because of the prepayments that have happened, so the servicer's on the hook for 3 years, right? And so if someone refinances their house, like millions of people were doing because interest rates went low, those are prepayments. And there's also people, I was telling Josh yesterday, that people who have refinanced their home or have bought a home, millions of people have lost their job now because of the coronavirus and because of companies laying people off. Those are first payments that aren't getting made. Okay. So because the servicer is on the hook for those as well, those are called, that's uncertainty of if they're going to receive payment. So you have a perfect storm. You have the prepayments with people refinancing before they had the loan for, let's say, 3 years. And they're hit with that. And then they're also hit with the uncertainty of the repayment. So the value of servicing that these companies normally make their money on, Wells Fargo, has went from 1%, and they were cut in half overnight. So they're basically worth 0.5% now. Okay. Which doesn't mean that much to me and you. Like, okay, they're making less money, but they're still working on, billions of dollars. But here's the problem. Let's see, the amount of money that a lender can lend is based on their net worth. Well, their net worth just got cut in half, basically. So now they are limited on how much money that limits them on how much money they can lend. Okay. And that's called capacity. Now, that is the reason that everything has been crazy. So what we're seeing is their lending power is not say cut in half, but it's been drastically reduced. Now imagine if any of our net worth was cut in half overnight. What would we do? How would we react? And what we would do is we probably just kind of like, we'd have 3 different personalities, and it depends on your risk aversion. But I think a lot of people would just back out completely and be like, okay, I'm going to protect what I have, and I'm not going to do anything with it. And I'm going to wait until this thing passes through. Okay. And then whenever we feel that things are coming back to normal, then we'll eventually, start lending again. And that's what a lot of banks have done. A lot of lenders have just gotten out of the lending game altogether. Okay. And then you have those that they will lend, but they're going to do a temporary stop, if you will, on anything risky. So anything like jumbo loans, anything, we call them non-conforming or non-QM loans, non-quality mortgages, jumbo loans, bank statement programs, all the funky stuff that kind of got the mortgage industry in trouble in 2008. Those were starting to creep back into the industry, and some people were doing them, and under 580 credit scores, things like that. Those are temporary, gone, like done right now. Okay, now that we think they'll come back, but we don't know when. And you got to think about, like, if they got out, how quickly are they going to rush to get back into those things if something like this were to happen again? So some of these things may have a ripple long-term effect that we may not know. And one of the biggest things that's going to affect a lot of us, and even clients that you may have under contract, or clients that you were pre-approved and looking and you're showing them houses, we could pre-approve people all day long with FHA at a 620 credit score, or VA at a 600 credit score, rural development a 640. Well, what's happened is some of those lenders that are still lending, okay, they have increased their guidelines now from 580 or 560 or 600 to all the way to 640. Okay, that's minimum now. That's a cutoff. You have some that have even went up to 660. And so at Premier, we're still doing 640. Okay, but you have some banks, like, don't be surprised if somebody tells you a 660 minimum credit score for any type of government loan. And we think FHA, but that includes our veterans as well. VA, that includes rural development. But we got an email, this was yesterday, so I haven't checked my inbox in the last 30 minutes because that's how quickly these things change. But we can still go down to 640. Okay, so how we're handling these situations is, if we have customers, this has affected a lot of our clients that we had pre-approved and looking. But we have just, like, if they're locked in, okay, let me start saying this. This is our policy, so I can't speak for everyone. But if someone is locked in at with us under a 640 or under a 660, then they're locked into an interest rate and into a contract. if you don't have to extend it and you don't and it doesn't expire on you, or they don't like go out and then get another house under contract and we have to relock them on a new address, that will be honored. Okay, those old guidelines will be honored. That's what we've heard. Now, and I'm hoping so because I have like two of them out there. And then but anybody new, it's 640 to 660 depending on what the lender's guidelines are. We're at 640 still today. So that's basically, but here's the deal. No one is doing business as usual. Nobody. And another thing that we're seeing, and we're having these conversations every day, is the Fed has tried to help, okay? But just like whenever the government gets involved in anything, there are unintended consequences. And so a big part of that is the public perception is that interest rates are really low right now, like the lowest they've ever been. And they should be. They should be that way, but they're not. And because of the reasons I told you, the capacity issues, the lenders just don't have the money to lend out. And this is everybody, guys. I got a conference call at 2:00 today with top mortgage originators all over the country that are going through the same thing because it's just so unbelievable that people think it's just happening at my company. And the purpose of this call is to really, for all of us to just have a pity party and feel sorry for ourselves and like say, okay, this is happening all over the place. So um, I'm still in the bad news, but I'm going to give you hope at the end of this. Okay. Um, so the capacity issues is the reason that business is not usual and or business as usual. And then let's see, I wanted to hit on certain things that some have paused it, some are still lending, but want the safe stuff. Like we talked about, they've increased their credit score thresholds. Now, those that are still willing to lend, okay, and that haven't gotten out completely, it's supply and demand. Everybody, it's on the top of everybody's mind. They want to refinance or purchase a home. The purchasing market's pretty much normal before this, especially. So supply and demand. What these lenders are now doing is they're raising the interest rates. It's called throttling. Okay, it's a word that nobody likes to talk about, but in our industry, but they're throttling the rates, meaning they are jacking up the rates to keep the business down. And it seems very unfair, but there's no law that prevents these guys from doing it. It's a free market. And so they can do it as long as they see fit. And some of these companies are like, no, we're just out. But some that say, okay, we'll lend, but we have to, make up for our risk that we're taking on this uncertain market. So we're going to raise the rates. Now, I think that's pretty much all the bad news. Okay, now the good news. The good news is that this is all based out of fear. And Josh and I were talking about this yesterday. This is not your typical, I've just told you why, but this is not based off of true economics. Okay. We were doing this number right here before all of this happened. Interest rates were low, our 401ks were up, stock market was up, the economy was really good. And then the only reason that the economy did what it did is because of the perception of this virus. And, the virus it's important. It's, we have to stay home and all that things, but the economic uncertainty that this has caused, I mean, you literally are shutting the number one country in the world down. And it's just taken a huge toll on the stock market, but even more important, people's just jobs, people losing their jobs. So it's literally like we just rewinded the tape back to 2008 or so. But the good news is it's probably going to be worse than 2008. Okay. The outcome is, but we rebounded from 2008 too, and I think we're going to rebound even quicker than we did in 2008 because 2008 was a true economic issue. Today, it's based out of fear and emotion. And as soon as we get good news, I mean, I may be wrong, but I think that we will catapult way past where we were, and that the floodgates are just going to open. I really believe that. And so all of the negativity in my industry right now, I've got people texting me like, man, are you holding up in this time? Like, in the mortgage business is crazy. And it is. But what we're doing, and I was talking to Josh about this, if you have people that are wanting to buy a house, or if you have people that you were showing homes to before all this started, and then they kind of click the pause button, then that's fine. That's their prerogative. But what my suggestion is that you kind of lead them through this time. Don't hide from this, as Josh likes to say. I mean, don't hide from it. Be the expert. Explain to them what's going on. Stay ahead of it, and then tee them up. That's kind of been my phrase from me and my team, is we're teeing everybody up. So it's a golf term, but you put the ball on the tee and you're just waiting for the perfect swing. And I think that swing is going to come whenever that curves, we start hearing the good news, okay, that the curve starts coming down, and people are starting to, companies are going to get hired again. And so historically, guys, if you have somebody that just has to buy a house right now, it's really, rates are still historically low. Okay. So I was talking to Josh about this. If you expand the interest rates and you look at it on a macro level, let's say a 10-year or even an 8-year, 5-year, rates are lower right now than they've been in the last 5 to 8 years. But what we saw, and what kind of psychologically has gotten in a loan officer's head and a realtor's head, because we see this kind of stuff all day, is that we were like, interest rates, we were using it as a selling feature. We're like, hey, rates are as low as ever before. Now's the time if you're on the fence, now's the time to get off the fence and buy and take advantage of these low rates. And we really can't say that anymore because those rates aren't available today. But we can still tee them up and say, hey, I talked to a loan officer today. He kind of explained to me why interest rates are higher than they should be. But I would just suggest that if you're on the fence right now, you go ahead and get the process started, guys. And no matter what lender you work with, I think that anybody right now we're not that busy with refis anymore. Okay. Those have pretty much been processed, underwritten. I mean, they're kind of like, and lenders aren't that busy either because of rates are doing what they're doing and everybody's just kind of slowing down. So I would suggest that you send your customers to the loan originator and your loan officer and say, hey, I've got these people, they're not wanting to do anything right now, but I would suggest that you get them pre-approved. Let's go ahead and pull credit, because credit's good for 4 months. Okay. So why not? I think all this thing's going to blow over, hopefully, within 4 months. And they can even get the loan sit to underwriter. The underwriter can approve the file TBD. Okay. Just all we got to do is, once you go under contract, everybody's going to be writing these 45, 60 days, 90-day contracts. It's just going to happen, because once the floodgates open, everybody is going to try. I've seen it. I know human nature. People are going to come and call us as soon as the good news starts hitting, and everybody's going to try to be doing the same thing at the same time. So the way you can keep that competitive advantage with your clients and your offers, in my opinion, is to get people pre-approved now and just tee them up. And that way, whenever the things start going good and your loan officer is like, hey, we got a pre-approval, it's already been underwritten, approved, we are just waiting, we'll probably need an updated bank statement, maybe an updated paycheck stub, and the appraisal and title. That's all we need. Well, I think that appraisals will probably take a little bit longer, and inspections we'll see. But right now, you can get a loan done pretty quickly because there's a lot of people still working, and inspectors still are inspecting. Some of them are, most of them are. Appraisers are still appraising, whether it's interior, exterior, or just exterior. Title companies are still pumping out titles in like 48 hours, so like things are kind of slow right now. But again, with the uncertainty, I think the best thing to do is tee your clients up. And then that way you can write maybe a 30-day contract when everybody else is writing a 60-day or a 90-day, a few months from now or a couple of months from now. So that's my suggestion. And then that you're dealing with somebody that has already been through underwriting. And that right there is a huge selling feature. If you got a hot, property that you're making multiple offers on, you say, hey, my customer's already been approved with underwriting. We have underwritten approval. We just need appraisal and title. We're done. I mean, a seller would like to hear that if they had 3 offers on the table, and so that's kind of my suggestion to you is to tee people up, and it makes people more sticky to you because as we know, you know, people aren't the most loyal. So they may call the sign in the yard, and you get cut out and you're like, man, but if you have taken the time with them and follow up with them and have referred them to someone that like and trust, like a mortgage person, and they've gotten pre-approved and you're just kind of working together as a team, I feel like I was telling Josh yesterday, I feel that these people are going to be more sticky to us and they're not going to be willing to jump from you to someone else because they've went through the process with you already. And then I was telling, again, just a little, echoing our conversation from yesterday, people just need hope right now. Like everybody's on Facebook, so just injecting little scriptures or just words of encouragement or quotes or hope. I mean, that's what we're called to be, is the light in this time right now. And I think when people see that peace and that steadiness in us, and that just draws people, to you. And so anyways, that's kind of like my mortgage spiel in a nutshell. But any questions? I know that it's kind of confusing, but at the same time, I mean, it is it's confusing stuff. And so everything that I just told you was from videos and newsletters and blogs and everything that I've read from much smarter people than me. And I'm just kind of trying to relay it to you. But Josh, I'll take any questions that anybody has.
Anyone have any questions?
Well, I do. If we have buyers now that are ready to buy, do we hold them off or do we let them go ahead and buy at these rates now?
Yeah, and so that's a good question. I think the reason that if you've got buyers now, then I would go ahead and just let them purchase now. I mean, I think the value, I mean, y'all know more about home values than I do and what they're doing right now. But as far as the mortgage side goes, I feel that, again, historically, they're as good as, they've been. I mean, they're just not, we didn't hit it at the low, like at the very bottom out. But a lot of customers don't know that. If we just explain to them, well, I thought rates were lower, that was kind of the purpose of this, is for you to say, well, they're not as low as you think, because and honestly, the easy answer is the Fed, when they cut the rate to 0, that doesn't necessarily mean that mortgage rates go down. And I think if you leave it at that, they're like, oh, okay. But no, I would absolutely, if you got somebody that's ready to buy through this process and they're not acting out of fear and it's a good decision for them and their family, we can make the loan work for them. And I mean, I can even get, if it costs a little bit to buy the rate down into the 3s, we're able to do that. So I sounded like doom and gloom at the beginning, but it's not as bad as it sounds. It's just, if you're in our shoes, it feels that way sometimes.
Okay, thank you.
Cody, I got a question. What is, if we wanted to, say we had a seller that's willing to contribute to buy down the points, say average $250,000 house, if we wanted to buy down the points, is that what is that, 2,500?
Yeah, so that's a good question too. So yesterday I had a real estate agent text me, what are rates doing today? And so I plugged in the scenario, this is my typical scenario. I plug in $250,000 sales price, $200,000 loan amount, so 80% loan to value, 750, 740 credit score, 30% DTI, just like kind of like your cut and dry, really good borrower. And the rate at par, meaning it wasn't costing you or crediting you anything, was about 4% on a 30-year fixed. It cost, but the spread, meaning each rate is tied to either a cost or a credit, okay? But the spread was flat between a 4% and a 3.5%. So it would have cost you $2,000 to get a 3.5% fixed rate on a 30-year, 1%. So if you look at that, man, like a 4% and 3.5%, a half a point difference in rate, that's pretty big on a bigger loan amount. So yes, that's a great point to make to your sellers and say, hey, if you're trying to put an incentive out there or whatever, that they're willing to pay up to 1%. Normally a 1% discount point will, right now in this market, will drop the rate about 3/8 to 0.5%.
Okay. So if we say that we're willing to buy down the rate on 1% discount point, is that what you're saying?
1% of the loan amount. So
1% of the loan amount. Okay.
yeah. But if you sell to your seller, hey, just think 1% of the sales price.
That's right.
It's going to be less because the
That's
people
right.
have to put a down payment in most cases.
Correct. And talk to us a little bit about closing costs. I know before all this sprung up a few weeks ago, I was seeing an increase in closing costs. I was hearing that a lot of, normally forever in a day, it's been $5,000 to get you through. And I was seeing a lot of $7,000 closing costs. So where are we at with that? And what do you recommend?
Yeah. So when we talk about closing costs, we talk about closing costs and prepaids.
Correct.
Yeah. So the difference, I mean, maybe maybe you don't, but just real quick, closing costs are like pretty much your fixed fees. Those don't change. And that's lender, appraisal, title and attorney fees, and recording, and title insurance is included in that. And then your prepaids, or if someone is escrowing, you have insurance, taxes, and if it's in a flood zone, you have flood insurance. So the prepaids, I always put a big question mark by them. And I'm like, these are our question mark fees, and these are the fees I know for sure. And so depending on title insurance, because the loan amount will change and the title insurance is a percentage of that. Our closing costs are about, let's say $4,000 is always a good rule of thumb just for the fixed closing cost, $3,500 to $4,000. So let's go high end $4,000. And then prepaids, about $2,500, unless it's, expensive home. Obviously we've seen insurance premiums at $2,400 a year. So that can change, but that's a good rule of thumb. So 5,000 is, I've always told my customers, like, plan on having your down payment and about 1,000 or 2,000 extra to cover the remainder of your closing cost, because really not a lot of sellers buck at $5,000. So I think what you saw, Josh, is in the last few weeks is that customers have been pre-approved or quoted a certain interest rate, and lenders are trying to honor those interest rates. But they're doing exactly what you said. Instead of raising the rate and somebody getting their feelings hurt about it, you say, look, we can keep the same rate. It's just costing, $2,000 to get that rate now. So they're raising the seller pay closing costs to cover the cost of the discount point.
That's right. Okay. That's what I kind of figured. I just wanted to see what you thought on that. So
because nothing has gone up. Lender fees haven't gone up, or they shouldn't have. Appraisal, title, and attorney fees, nothing has changed. So that's got to be the only thing I can think of.
Okay, perfect. What about this? I see, again, if it's on Facebook, the old saying is it's got to be true. But no, I see a lot, about some borrowers needing reserves. Is that something you're seeing now? Is that a trend, or where are we at with that?
Well, what's happening is they want the real safe loans, and they love reserves. They just salivate when they see money in the bank after closing. So especially now more than ever. Now, I haven't read anything that has changed guidelines or so when we do loans, we run it through Fannie Mae and Freddie Mac's system. It's called DU, Digital Underwriting, or LP, Loan Prospector. And we basically get back an approval or a referral. Okay. So when we get an approval, we look at our findings, and they tell us how many months of reserves we need. A lot of the times we kind of get good at playing with the numbers a little bit. So like if let's say someone's at a 48% debt to income ratio and their credit score is under 700, it may not approve it without reserves. But if we plug in, let's say 2 or 3 months reserves, then that's the first thing we do to see if that compensating factor will kick us over to an approval rather than a refer. And then we just tell the customer, like, hey, go get a gift for your down payment, or do you have a 401k or whatever? We try to work through the easy path of least resistance to try to get those reserves in the file.
Perfect. Now I know you're not an economist, but you're in this every day. So we hear a lot about this bailout or this stimulus with the Fed coming back and saying that they'll buy any mortgage-backed security. Where do you see that in the next two weeks to a month? Where do you see that with them pumping cash? Is this going to improve our situation? What do you, educated guess? What do you think?
So last week alone, the Fed bought $40 billion of mortgage-backed securities, and that's huge. Typically, they don't either buy any mortgage-backed securities or maybe 8 billion, maybe a week. We're talking 40 billion, and in some cases 20 billion a day. It's just mind-boggling insane. And so typically what they're trying to do is they're trying to lower the rates. That's what they want to do. But again, unintended consequences. What's happening is we're having all these hedging issues, and these lenders are doing margin calls. And so they're actually losing money as the rate goes down. So that's why they're keeping the rate up. And it's just not working. What the Fed's doing is not working. And so experts are trying to get the Fed to reduce their purchasing of mortgage-backed securities and just let the kind of market play out. And let's get past this a little bit, and then things will go back to normal. Because, Josh, rates right now should be like high twos on a 30-year fixed. It's just, obviously we're not seeing it, and they don't have the capacity to lend the money to those who would want the rate in the twos. Probably everybody on the screen would want to refinance if it was 2% right now. Exactly. So that's why they just have to keep them up. And so the Fed, like, people are trying to get through to the Fed that are in this industry and say, you got to stop doing what you're doing. You're not helping the situation. And so hopefully they'll kind of stop doing what they're been doing. And I would hopefully in 2 weeks, somebody gets the picture and just stops pumping money into it. Now, the stimulus package, I do want to talk about, another thing that is going to impact us and our clients, on the face-to-face conversations we're having. Something that gets a lot of attention on the news is that you don't have to make your mortgage payment right now. I've heard that. Or companies aren't requiring that you pay your bills, basically like your auto loan and your credit cards and things like that. That's actually, and with Facebook, again, true stories, that are coming across, everybody's like, oh, this is great. Yes, that there is, let's see, what's it called? I wrote it down. A CARES Act is what they're calling it. But to qualify for that is very difficult, and it's not very thorough. And so I understand there are going to be people that cannot make their payments. Okay. That's understandable in this situation. This check that people are going to get, it's not going to last them very long. Okay. Rent, mortgage payments, they're due on the 1st, late after the 15th, typically. So that money's going to run out. But what we've got to tell our customers is if they rent, they need to do the best they can to pay their rent, because mortgage, I think lenders are going to want verifications of rents. We call them VORs. They're probably going to want VORs more now than ever. They're going to want VOMs, or obviously the credit's going to show verifications of mortgages or mortgage lates. Y'all, a mortgage late, that's like automatic, almost deal killer. Now, we're in an extenuating circumstance, so we can explain it, but lenders are going to look at that and they're going to say they didn't have the discipline, or whatever you want to call it, to call the lender first and work out a payment plan with them. Okay, so if you have anybody that talks to you like, they just lost their job, or their income got cut in half, the mom's not working because she's having to stay at home with the kids, whatever the case is, if they have a mortgage payment, they either need to pay it or they need to call the servicer, and they need to ask for permission rather than forgiveness later, because it's going to be a lot easier for a bank to approve that and say, yeah, no problem. We'll defer it, pay what you can. Now, that doesn't mean that it's going to be forgiven completely. That just means they're kicking the can down the road. Okay. They're still accruing interest. It's all going to be due eventually, but it might put them in a better position. We just are really wanting to protect people's credit right now, because these are the people that are going to get affected 12 months, 24 months down the road if they don't make their payments on things like they should.
I do have a question on that. So if we have a client, maybe they've got a furlough. I'm seeing that some. You know, they haven't lost their job, but they've been cut back to very minimum. Maybe in some cases they're not even getting paid, but maybe keeping up their health insurance. So
Yep.
they've been furloughed. If they work out a deferment with their current mortgage, does that negatively impact their credit? Does a lender report that deferment, or does the lender just say, you know what, pay us X amount every month, and then we'll reassess this in 4 months or 3 months?
Mhm.
How does that?
That's a good question, because we haven't seen the credit. Typically, yes. If it goes into something like that where they work out a payment plan, it does negatively impact their credit report. So I'm interested to see, but here's the deal. Fannie Mae and investors and Freddie Mac have really come out and try to stay ahead of this thing, as far as, you know, like the appraisals. They're more lenient on appraisals. It doesn't have to be just interior, exterior. It can be exterior, if you know. And so I think that there are going to just be a lot of exceptions, a lot of letters of explanations written, and a lot of underwriter judgment calls. But my goal is to keep the almighty FICO, you know, high. And so whatever they can do, and they need to ask that question honestly, because it may be different with every servicer,
That's
if
right.
they're going to report it on their credit report or not.
Perfect.